So good afternoon, folks, and welcome to Marcellus's webinar, India's Moment After a Decade of Structural Reforms. I'm joined by Rakshit Ranjan, who's a familiar face to all of you, our CCP fund manager. And I'm also joined by our economist and one of our analysts, Nandita. A lot of the work that you're going to see is work that Nandita has done over the last couple of years in helping us understand the economy. I will follow the usual format, folks. I'll present, then we'll open up to Q&A, so you can keep firing your questions in that Q&A box. All questions acceptable, stock specific, sector specific, country specific. We'll try our best. We've got 1.5 hours. My voice is a little busted. So as long as my voice holds up, we'll keep answering your questions. Right. So let's get down to it. Let's get into the slides. So we'll try to pack a fair bit in because a lot has happened in our country in the last decade. And one of the reasons we are doing this is we tend to notice people not just globally, not just outside India, but many people in India themselves actually have very little idea how dramatically the country has changed in the last decade. And because people don't appreciate the scale of the change that's taken place in India over the last decade, the focus tends to be on matters of secondary import, such as, say, the unfortunate conflict in Ukraine, such as oil prices, such as Federal Reserve. Right? I'm not saying Federal Reserve oil price is unimportant, but in the context of the momentous changes that this country has seen in the last decade and the impact that those changes will have on your and my wealth, oil, interest rates are second order events, and we just want to sort of set that imbalance right by getting people to focus on what actually matters rather than sort of macro nonsense, which tends to preoccupy people's minds. Right. So one way to understand a lot of what we're going to describe is a lot of what India is going through is very similar to what transpired in America in the 50-60 years prior to the Second World War, the 50-60 year period in which America became a superpower, right? And a book which captures this beautifully is this one. I've referenced it before, Robert Gordon's The Rise and Fall of American Growth. And essentially what Gordon describes in his book is, in those 50-60 years prior to the Second World War, America got networked, right? The railroads came along in 1880s, the telegraph came along, Model T Ford, the world's first mass-produced motor car, came along in 1908. Road networks were ready by the Second World War. And this joining up of America helped giant national enterprises emerge, right? Giant companies emerged, and they obviously grabbed hold of national markets at the expense of smaller competitors. Broadly, three sets of forces helped them, right? The first was, if you build in an era where technology was becoming important, large-scale research and development, industrial scale R&D became important. For example, General Motors created the Chevrolet. Model T Ford was 1908. In a way, the first high-tech modern car, the Tesla of its age was the Chevrolet, and General Motors created that from an R&D setup. IBM created the modern computer. Bell Labs created many of the breakthrough advances in science, such as the semiconductor, through the 40s, 50s, and 60s. Alongside that, the rise of national advertising, sales, and distribution. We take these as given today, that there'll be pan-India or pan-America advertising, sales, and distribution. The onset of this, the inception of these networks was this 50-60 years running up to the Second World War. And most importantly, perhaps, the rise of modern finance. The stock market in America, by and large, boomed pretty much non-stop from 1890 through to 1929. I think there was one bust around 1905, but barring that, it had a 30-year boom in the stock market. The rise of the first generation of investment banks like JP Morgan, Goldman Sachs, Lehman Brothers, right? So organized finance, low cost of capital, pan-American market, industrial scale R&D, and you created the sorts of companies that we know America for. I've flashed some of the names on the right-hand side of the page, right? If you want to understand India in a nutshell, what we are going through is very similar. India is going through a corresponding phase of its development where we are joining up the country, networking India, and creating giant, highly profitable, highly cash generative businesses, which you and I are making money from. Now, a publication which has captured much of this actually very vividly and very accurately to our mind is The Economist, right? So some of you would have read it on 13th May. The Economist, who's historically been, to be fair, The Economist historically has not been a fan of India. I can't remember in the last decade or so, particularly positive coverage on India from The Economist. But the 13th May issue of The Economist was very positive. Those of you who haven't read it, I would strongly encourage you go online, read it, because they've done a super job of describing the changes. And then the bottom line, the conclusion they're driving on at is what we are seeing in India today is a new pattern of growth. It is unlike anything you've seen before, they say, The Economist says. And these changes, The Economist says, these changes help explain why India is forecast to be the world's fastest growing big economy in 2022, and why it has a chance of holding on to that title for many years, right? So this is the Economist based out of London. The full team came down to India, and I met them, worked with them, and gave them inputs for this momentous cover story. We'll give you a summary of that cover story. I'll leave it to you to read it at your leisure. But the summary of it, and which we'll expand upon over the next 20 minutes, is first aspect is the communication and infrastructure networks have grown exponentially in the last decades. For example, broadband connectivity has risen 40-fold in the last decade. Local airline traffic has tripled. Secondly, a whole range of changes in the tax regime, right? Probably one of the most comprehensive tax regime revamps of any large economy since the Second World War. GST, corporate tax rate reduction, a sharp crackdown on tax evasion. And we'll give you the data. The data is actually very clear on how powerful this crackdown has been. And therefore, the exit of tax evading companies by the thousands. We'll share some data with you on that as to just how many thousands of companies are shutting down as they fall prey to the tax man. Right, that in turn is driving epic financialization of savings. Right, even for people like us who earn a living by investing in the financialization of savings, some of the data that's coming through at the pace of financialization of savings is quite breathtaking. Right, the number of brokerage accounts, for example, has quadrupled over the last decade. The banking system is the strongest it's been in India's history. Again, we'll share with you data on just how strong the banking system has become. It's quite astonishing in the space of a decade, and the health of India's banking system has turned around 180 degrees. And finally, I think this is probably the most important aspect of India's change, the rise of the JAM construct, Jan-Dhan, Aadhar mobile, linking that to the India stack and thus laying the foundation for what has become a very effective, and I would submit to you, what will become an essential framework for providing social security to hundreds of millions of people who will not be able to get jobs, right? We've seen the whole Agnipath Agniveer episode. There is no easy answer to this. And the Jan-Dhan Aadhar mobile with the combination of the India stack will become the spine of what will allow the country to hang together as we go through a decade in which people like you and me will feast on a booming economy. But unfortunately, the bulk of the labor force, which doesn't have skills, will need to hold their lives together. The JAM construct, I'll explain in a bit, is critical for that, right? Now, let's go into the details a bit so that you understand the scale of the change and you worry less about second order stuff like currency and oil prices and Federal Reserve. Let's start with the transport and communication networks, because this is where the changes are the most sort of vivid, most tangible. We've doubled the NHAI has doubled the highway network in a decade, right? But the most striking development on infra build has been the rise of industrial corridors and freight corridors, right? We built nearly 9,000 kilometers in the space of 10 years. We built nearly 9,000 kilometers of industrial and freight corridors. We create a little map of India. You can see the corridors there. A decade back, basically none of this existed. All these green lines and purple lines you're seeing on the chart, neither the freight corridors nor the industrial corridors existed in any meaningful shape or form back in 2010, 11, 12. And hence, for a country of India's scale, to put together the best part of 6,000 kilometers of freight and industrial corridors is quite a big deal. All of you, I'm sure, have seen this. Air passenger count has more than trebled in the country. All of us know the airports that we fly through, the airports in Delhi, Bombay, Bangalore, Hyderabad. None of them existed in anything remotely like its current form, right? In Delhi, Bombay, Bangalore, Hyderabad, Kolkata, barely any city in India had an airport remotely resembling the current construct a decade back. And one of the reasons these airports are much bigger is the quantum of traffic flying through is much higher. Bank accounts, we'll come back to this. 80% of Indians now have bank accounts. But the most exciting development, and this is a link through to Jan-Dhan Aadhar Mobile, is UPI. UPI is quite remarkable, right? A lot of people, because we use it. So when I go home on my this evening in an auto rickshaw, I'll pay the driver through UPI, right? We don't realize how unprecedented it is. It is the world's largest real-time payment interface. From next to nothing 5 years ago, it now accounts for nearly $600 billion of transaction value. In fact, I'm pretty sure the latest data is higher. We've given you slightly dated data on UPI transactions, 600 billion a year, and it is free, right? Very rarely do you find a fintech construct, an electronic payment construct on this scale at absolutely free of charge. The effect of this on how our payment system works has been remarkable, and you can see it in this little table, right? A decade ago, roughly half of our retail payments used to be paper-based, right? Checks and MCR, MICR, I remember it, in character interface, right? Now, barely 1% of the retail payments are paper-based, right? You can see the dramatic transformation in the space of 10 years and how our retail payment system works. I doubt there's any country in the history of the planet which in the space of 10 years has completely pivoted how retail payments are made, right? Ally that with the growth in communication, transport, ally that with the growth in communication networks. 43% of India is on internet now, up from 8% a decade ago. We are the world's biggest users of data. No other country uses as much data as we do. And remember, that's with 43% of Indians on the internet. Imagine what will happen as 60-70% of the country hits the internet over the next decade or so. One of the reasons we are the world's biggest users of data is because the price of mobile data in our country is 1/3 of what it is in America, right? These changes are powerful. Very rarely will you and I live in an era where in the space of a decade, a country will put together 6,000 kilometers of freight corridors, industrial corridors, change its payment network, retail payments networks 180 degree, and become from nowhere to the world's biggest user of data. These are epic changes, and the effects of this we'll discuss in a bit. Next comes the tax reforms, right? Tax reforms and the impact that it has on the black economy, right? As everybody on this call, I'm sure knows, GST 2017. What some people might not appreciate is the impact it's having on tax collections. Right? Indirect taxes as a percentage of GDP have now reached a record. It's becoming, because of the way GST works, with each passing year, it incrementally gets harder and harder to evade GST. And a downside of that we will discuss in a bit is chota companies who were earning a living by evading tax are shutting down in greater and greater numbers. There's data on that as well we'll share with you, right? Result is, I'm sure you've seen these headlines every now and then. They get headlines on GST scams being busted, and a whole industry is mushrooming to help small companies deal with the GST tax man. Right. Moving on beyond GST, as everybody knows, the income tax regime for people like you and me was altered. I enthusiastically signed up for moving to the simpler construct where I pay a flat rate rather than going for that year deduction, woe deduction. I simply pay a flat rate. More and more people are choosing for that. It's a simpler, neater way to pay tax. So both on indirect taxes and on direct taxes, tax collections are on the rise. Now, this data is very striking. So if you look at India a decade back, say FY11, FY12, we were collecting basically around 10% of GDP as tax. That's a pretty poor number. The Western world does 20, 25, developing Asia does 15. So a decade back, we were in poor shape. 10% of GDP was being collected in tax. In spite of COVID, you can see the FY22 figure is pushing towards 12% of GDP. In spite of COVID, the FY22 figure on tax collections to GDP is pushing towards 12%. My reckoning is, looking at the technology involved in this number will rise, and that portends well because one of the reasons the the rise of the tax ratio portends well is it's formalizing the economy. The unorganized sector is getting crushed. In industry, after we've used pipes as an example here, where a decade ago 50% of the market was unorganized. Now the unorganized pipe sector, where say where our investments, Marcellus's investments would be Astral Poly, the unorganized pipe sector has shrunk from being 50 to less than 35%, right? And this sort of story is repeated in sector after sector. The reason for that is the rise of tax collections, which is forcing informal sector players out of the picture, right? Then we come to the banking system, right? A decade ago, it was a nightmare, right? I remember we just arrived in India. We used to meet these incredibly corrupt power and infrastructure companies who were fairly openly looting the banking system. They were looting the stock market as well, but you could argue that the equity investor is as culpable there as anybody else. But these guys were hapless. They were looting the hapless PSU banks, and they were also looting some naughty private sector banks, right? By 2015, as I'm sure many of you remember, the banking system was basically in intensive care, right? The RBI obviously didn't say it in quite those words to prevent panic, but by 2015, we had a broken banking system. I think three sets of things happened to get the banking system back on track. A whole ecosystem of people have worked bloody hard to get the Indian banking system fixed. I think first up, a lot of credit to the erstwhile RBI governor, Raghuram Rajan. Unfortunately, he's no longer there. He's gone to Chicago, back to his teaching role in Chicago. He did a very gutsy thing. He basically took on the banks and said, you guys are not reporting your crap. He drove something called an asset quality review. And he forced the banks to cough up the fact that they had underperforming loans, and basically that lent to crony capitalists, and they were underreporting those bad assets, right? My submission would be one of the reasons Raghuram Rajan had to leave the country is because he did the right thing for the country. Right. Next up came the Insolvency and Bankruptcy Code, which was promulgated when Rajan was at the RBI. But for this, the political system also deserves credit. I'm pretty sure a big part of the crony capitalist crowd pushed back against India creating a bankruptcy code. As many of you know, till 2016, the word bankruptcy was not defined in our country. Right? There was no legal definition of bankruptcy. Courtesy the whole bankruptcy regime, there's a well laid out procedure now for companies who don't pay their bank loans to be declared bankrupt. Their assets are seized, they're sold. And as I'm sure you would have read, in the last 3 years, some of India's most prominent crony capitalists, people who have looted the banking system for 40 years, they've now lost control of their companies in the bankruptcy process. I don't think enough has happened, but I think there's enough has happened for us to be cheerful, but more could be done to hold these people accountable for how they deal with their loans, right? And lastly, in the last 3 years or so, the government has merged some of the PSU banks. The government wants fewer but stronger, better capitalized PSU banks. If you quantify the impact of all this, it's quite remarkable, right? We've tried to capture it in a chart. Stressed assets ratio, FY21 data was suggesting it's approached 4.5% of banking system assets, which is a good place, right? It was as high as pushing towards 7. Our reckoning is when the FY22 end data comes out, stressed assets as a percentage of banking system is going to be pushing closer to the 4% mark, which suggests, especially in light of COVID, it suggests the banking system, which is broadly in good shape. Most encouraging is the capital adequacy ratio, right? Capital adequacy stands at 17%, roughly for every 100 rupees of loans that Indian banks are making. The bank's own capital is 17 rupees out of 100. That's a record. We've never had a banking system which has been as well capitalized. And as I'm showing you, troubled assets are under control. You can understand, therefore, why we are so optimistic about Kings of Capital, why we get a little perplexed when people worry about, say, HDFC Bank or Kotak Bank or Bajaj Finance and so on. So that's the third layer of change. Let's go to the last. And as I said, this, I think, is the critical layer. This is going to be India's bulwark as we deal with the fault line of broadly 100 to 200 million people who don't have the skills to operate in a modern economy, right? How did Jan-Dhan Aadhar Mobile come together? I'm sure most of you are familiar with it, but just a quick recap for those who aren't. Jan-Dhan was a government-driven scheme back in 2014-15 to create bank accounts for all citizens. Aadhar was the brainchild of the great Nandan Nilekani. He conceptualized it more than a decade ago. All of you now, all of us have Aadhar numbers, and that's a unique system. Every Indian has a unique ID card. Finally, we all have mobile phones, and these three things get seeded with each other. Bank accounts, Aadhar, mobile phone, you seed them with each other. You create a digitized social security network, right? The numbers are mind-boggling. 333 crore Jan-Dhan accounts, 123 crores Aadhar numbers, 121 crore phones. No other country in the world can do anything comparable. But why this is important for us is this has given the government a very efficient means of pumping benefits to the poor. We were giving benefits to the poor before as well, but a lot of that was being looted by the middleman, right? Various research suggests between 50 to 80% of the benefits were being sucked out by middlemen. I remember all the way back in the mid 80s, Rajiv Gandhi gave a speech saying that for every $100 of benefits given, barely $15 reaches the deserving recipient. Baki $85 is stolen by middlemen in between. There's another problem. There used to be duplication. In the Purana system, because there was no way of knowing whether Saurabh was claiming both in Bombay and Saurabh was claiming back in his native village, Saurabh could double claim, or imposters pretending to be Saurabh could double claim. With Aadhar, the duplication goes away, and therefore you have created a far more efficient system for doling out $70 billion per annum roughly of social security benefits to the poor, right? These are meaningful numbers, and there's good data now, good research coming through that this construct, the Jan-Dhan Aadhar mobile construct, is helping the poorest in our country hold it together. Inequality, this piece of research commissioned by the IMF, done by prominent Indian academics, Surjit Bhalla, Arvind Virmani, famous economists, amongst others. What they are showing is that inequality in India is being meaningfully reduced by these social security transfers. As all of you know, not only is JAM being used for social security transfers, the combination of JAM with UPI is also driving things like the COVID vaccination process. It's also being used for, say, paying highway tolls. This whole thing is called the India Stack, and even people like us, people like Marcellus, we are piggybacking on it to sign up clients using the KYC construct that JAM allows us to piggyback on the back of. Quite remarkable what's been built here. This is very, very valuable. No other country in the world has anything like it. Now, what does this all mean for us? Let's now get into the brass tacks, right? Economy ke liye mean kya karta hai? Companies ke liye, what does it mean? How much money can you and I make from this? So let's just quickly summarize 4 sets of changes: tax reforms and crackdown on tax evasion, transport and communication networks, massive scale investments in transport and communication networks, right? Banking system reform, cleansing of the banking system, the India Stack, JAM, digitized social security, right? What is it all resulting in? First layer, right? It's pretty clear that tax evasion is getting squeezed. The organized sector, lots of very credible data showing the organized sector is gaining share vis-a-vis the unorganized sector year upon year upon year. Secondly, the financialization of saving, right? We'll keep coming back to this again and again. Breathtaking developments here. Just one specific facet has been illustrated: the rise of demat accounts, right? We had 19 million demat accounts in India 10 years ago. Today we have 90 million. 19 ka 90 ho gaya. Right? And finally, American style, as you network the country, as you kill the tax evaders, right? You concentrate profitability in the hands of a few companies. Our latest research suggests that the top 20 profit generators in India account for 70% of India's profits, right? Now, what does this mean for the economy, right? Let's start with the households. Let's start with millions of people like you and me. The data on household balance sheet suggests that households' financial health is better than it's ever been before. So if you look at household debt, which is the blue line, it is approaching 50%, but 50% in the context of India is not a particularly high number. The most startling figure is household financial savings to GDP, which 5 years ago was around 7.5%, and which today is north of 15% in spite of COVID. Imagine, right? We're a relatively poor country. In spite of COVID, household financial savings as a percentage of GDP has doubled in the last 5 years, right? let's look at now the external balance, right? So the household balance sheet, let's go to the external balance sheet. How does the rest of the world trade with India? Our current account deficit a decade back was pushing 5%, right? The currency was in bad shape. Whilst because of the oil price surge, we still have a current account deficit. It's closer to 1% than to 5%. The dashed blue line here, this suggests a meaningful structural improvement in India's current account deficit, and there is a tangible benefit of this for foreign investors. If you look at India's long-term depreciation of the rupee since 91, it's been around 4% per annum. In the last 10 years, the rate at which the rupee depreciates has dropped to 3% per annum, right? Meaningful reduction in the pace at which the rupee depreciates. Why has that reduced? Because our current account deficit has come down. We've become a more self-sufficient country in terms of CAD, right? There's further deeper economic fundamentals which drive this, not least the drop in the inflation rate. Again, because of developments around oil prices, currently inflation is 7%. But if you take a decadal trajectory, inflation today is lower, significantly lower to what it was a decade back. Half of CPI inflation, the CPI basket in India, half of it is food. I've seen repeatedly in India, this government, the preceding government, is a tried and tested a playbook that successive administrations can have used to bring food inflation down under control. But structural inflation, leaving aside food and oil related issues which will keep cropping up from time to time, structural inflation seems to be in a better position now than it was a decade ago. And these two things are linked, right? Because the bigger your inflation differential with America, the more your currency will give way. Ironically, as I speak to you today, America's inflation rate is higher than India's, right? I didn't think I would live to see that, but we are at that strange juncture in history where America actually has a higher inflation rate than us. And all of this obviously boils down to economic growth, which has held up against all odds. Honestly, when DeMon happened, when GST happened, when COVID happened, like many other people, I also thought that the economy will get pounded. But as you can see from that GDP chart, through the last decade, growth has been around the 7% mark, which is a remarkable outcome. I think it could have been better, but hey, 7% is still enough for you and me to compound at a very healthy rate and focus on the structural strength of the economy rather than the second order macro nonsense. Now, obviously, every set of structural changes has a dark side, right? And so in India, right? I'm sure all of you read the newspapers and you read about what's happening in the centralization of power. You read about the stories about phone tapping and so on. I'm not going to get into the details there. GST also means a greater degree of centralization of power. Perhaps the most tragic aspect of what's happening in our country is because the economy is getting more networked, higher tech, lower cost of capital, right? Unskilled workers are on a hammering to nothing. So this chart from Kotak Institutional Equities beautifully shows both facets of India. The orange area is the formal job creation, right? And if you take Kotak data or if you take EPFO data directly, pretty much every year we're creating 10 million jobs in the formal sector. So people who are listening to us today, people like us on this call, 10 million jobs for people like us are being created, which means in the last 3 years alone, India has created around 30 million jobs. Just to put that into context, France's entire workforce is 30 million. The tragic aspect is the green area, which is the decrease in informal jobs, right? Blue collar people with low skills, unfortunately, they neither are required in factories, nor are they required in call centers, nor are they required in construction sites. Everything from a construction site to the building of the coastal road in Bombay, to building NHI roads, to call centers of gigantic banks, everything unfortunately is more and more mechanized and computerized. And hence for low skilled blue collar people, there really is very little that this country can offer them. And hence the necessity for Jan-Dhan Aadhar mobile to pump money into their bank account. Excuse me. Right. Then we come to the issue around small businesses. I told you, right, as the government cracks down on tax evasion, as GST gets harder and harder to evade, in their tens of lakhs, small businesses are shuttering down. And you can see the trigger. 2017 GST kicked in. And just look at the jump in small businesses shutting down. This is Ministry of Corporate Affairs data. Just look at the jump in small businesses shutting down every year. Basically 6 to 7 lakh small businesses are winding up, and I don't think this is going to stop. In a way, we in Marcellus, the companies we are investing in, are hoovering up this market share, as every year 6 to 7 lakh small businesses wind up, right? And we can't live in a free market economy and wish these things away. This is the flip side of structural change. Coming back to our companies and how are they benefiting, right? In simple sort of financial terms, I'll become a little technical now. There are three sets of benefits for our investee companies. Because of better communication networks, because of better infrastructure, working capital cycles are shorter, right? Your trucks move quicker, your SAP and your ERP systems reduce working capital cycles. You have less inventory, you get paid by your customers quicker. Secondly, because cost of capital is down, because successful companies have cash, they're investing in automating their businesses, whether it's a Bajaj Finance ka collection system automation, or it's a Asian Paints ka factory automation, right? Companies we have invested in have automated their businesses. As a result, asset turns are better. For a given amount of capex, zyada paisa banta hai. The return on capital on that capex is greater because that asset gets sweated better. Thirdly, as the country scales up, as you join up the country, you create an integrated colossal market, a $3 trillion market. The larger the scale of the market, the better the operating margin, straightforward scale economies. All of that means more cash flow for the companies we've invested in. The companies then take that cash flow, slam it back into the business to generate compounding for you and me. Right, I'm going to give you three examples. This will be familiar to Marcellus clients. I'll go through them quickly in that regard. You could have heard from us for years now, 3 years now, for about GMM Pfaudler. We locked into it 3 years ago when we realized that what it has, this is the world's #1 glass-lined reactor company. They make these giant ceramic vessels inside which medicines are made. We realized the skill sets they have, the technology they have, is amongst the best in the world. They're much larger than the nearest competitor. We spoke to their customers. The customers gave us glowing references to GMM. And as we delved into GMM's financials, what we saw was a virtuous cycle. As GMM generated greater scale, they generated more cash flow. As they redeployed the cash flow, their dominance grew. In the last 5 years alone, GMM has tripled capacity. They have tripled capacity in the last 5 years. All of this cash they then took to deploy it to brilliant effect. During COVID, they bought first their main local competitor, a French company called D. Dietrich, based in Hyderabad. Foreign company, had never made money in India. Within 6 months, GMM started making money out of that Hyderabad plant. And then, as most of you I'm sure know, they went on to acquire their global parent as well in August of 2020, right? Dr. Lal Path Labs, another investee company, similar story, slightly more higher profile. This is the largest largest medical diagnostics chain in the country, right? Heavy investments in technology, not just SAP, but also use of artificial intelligence to drive a recommendation engine, which tells people like you and me what to do when, right? Live tracking of samples, the fastest delivery of test samples to you and me. The use of technology has allowed them to have a working capital cycle of zero, right? Pretty much the only medical diagnostics company which operates on a zero working capital cycle. And then you can see the scale effect once again at play. GMM, I told you, had tripled capacity. Dr. Lal in the last 5 years hasn't quite tripled. They've sort of gone 2.5 times. But because you're scaling up, you can sweat that scale with technology better. Your asset turns are better. Your scale is higher. And on that scale, you're sweating those assets much harder than you did before. And you're operating on a zero working capital cycle. That's a lethal combination. Very difficult for any tech, fintech, anybody else to compete with a company with comparative advantages as deeply rooted in scale and technology. Again, a name which will be familiar to those who read our books, Page Industries. Remarkably, all the way back in 2008, when Page was a mere $30 million company, they'd already invested in ERP, right? And they grew rapidly. I remember we published Unusual Billionaires in 2016. And by that stage, they were compounding profits and cash flows at around 25%. Then they hit a snag, FY 14 to 18, as Rakshit has written in some of his newsletters. They didn't invest enough in technology. In India, if you don't invest in technology, that's your biggest bugbear. They didn't invest enough in technology, 14 to 18, and as a result, they ran into challenges, especially once GST kicked in. And GST basically ushered in a far more higher tech world. To give enormous credit to Page's management, they realized that they had messed up on the technology piece. Last 4 years have been a blitz of technology investments, auto replenishment systems, the use of Salesforce, the use of something called Blue Yonder, which figures helps you optimize inventory. You know how much inventory to have in the factory, how much to have in which warehouse, which part of the country. As they have invested in tech to optimize working capital, optimize inventory, you can see the reduction in working capital days. That in turn frees up cash flow. If your working capital is tighter, shorter, your cash flow is freed up. They've reinvested that in becoming number one in a segment, which till 6 years ago was barely 15-20% of their profits. In loungewear, Page today, 55% of their profits come from loungewear. They're the undisputed number one. From being undergarment market leader, they've also become the loungewear market leader. I think they're as big as, Rakshit, can you hear me?
Yes, sir.
Page and loungewear would be as big as what Nike, Reebok, Adidas put together?
In loungewear, well, Nike, Reebok, Adidas is loungewear put together. Yes, Page will be bigger than that, in fact. But shoes of Nike, Reebok, Adidas make them bigger.
Right. So now let's do a sort of overall look, right? So we went into our coverage universe. We, across our various portfolios, we own around 30 stocks, right? And we took some of them out. We did a mixture of large companies, Nestle, HDFC Bank. We did some mid-cap companies, Page, Dr. Lal, Astral, and we also deliberately put some small cap to give you a sense of how this whole thing pans out. It's not, a lot of people say large cap mein lagaye or small cap mein lagaye. We've never quite understood logic, because across the piece, capable, smart companies are benefiting from the structural changes we've described so far in the presentation. So look at three aspects of this change. Let's first look at the working capital days. FY 13 to 16, 74. FY 16 to 19, 68. And then the latest working capital cycle data, 54. Remember, through COVID, pretty much everybody's working capital cycle expanded. But the smartest companies were still able to shrink their working capital through COVID. And then the next thing I would point you towards is the operating margin. As these companies gain scale, right, over the length of the spread of this table, right, top line scale is growing around fourfold, and bottom line PBT scale, PAT scale, profit scale is growing around, say, sixfold. So the dhanda, the business as a whole, is scaling 4x over 10 years. As you scale the business, your operating margin goes from 17 to 18 to 19%. And the single most important metric to gauge a company's health, ROCE. Most nifty companies don't even get to 15%. The sorts of companies we keep investing in for our clients, ROCEs a decade back were pushing 26%. Even in spite of all the drama of the last 5 years, they're still pushing 25%. Return on capital, well above cost of capital, which means hefty free cash flows. Around 15% of capital employed comes out of the dhanda as free cash flows. These companies reinvest that money. If you keep reinvesting 10 to 15% extra free cash flow back into the business every year, you can see why many of these businesses trebled their scale over 5-6 years, right? And all of this basically drives compounding. Now, to be fair, this story is not restricted just to our companies. It would be a tragedy if it were. This story, what I have to take you through, is India's story. And you can see that using a very simple screen. If you took the last 15 years of data on the BSE 500, last 15 years of data on the BSE 500, and every year you identified those companies which in that year were above median, above average on ROC, and above average on reinvestment, right? So every year you identify companies who are above average on two dimensions, ROCE and reinvestment. Reinvestment, because reinvestment is the driver of growth. Reinvestment means investing cash flow divided by operating cash flow. Every year you'll find around 20 to 25 such companies, right? And you can obviously create a nice little spreadsheet with 15 years of 20-25 companies each year. What you'll see is remarkable. What you'll see is that these companies, which have grown, which have been above average over the last 15 years, Their share price returns have compounded at 16.5%, but their free cash flow growth is closer to 22%, right? So 16% share price, 22%, 22% free cash flow growth. What that means is the stock market hasn't yet valued these companies fully. There's a full 5% gap conservatively. There's a 5% gap between the free cash flow growth these companies are generating. 22% free cash flow is a number we are very familiar with. You would have seen dozens of Marcellus presentations where 22% free cash flow growth over long periods of time are shown, right? What we are telling you is this is not just restricted to Marcellus companies. Any sensible investment method can lock into these companies generating 22% growth, but the share prices of these companies haven't grown at 22. They have grown at closer to 16, 17, which means there is no quality bubble there, right? It's not as if share prices have run ahead of free cash flow. In fact, share prices are behind free cash flow. Where there is a problem in our country is in below average companies, right? So if you take the rest of the universe, the above average, say, hata dijiye above average, focus on the rest of the universe, share price returns have been 14%, free cash flow growth has been 9%, right? So if you have overvaluation in India, it's actually in substandard companies. The sorts of companies we invest in, or the sorts of companies anybody sensible would want to invest in, which is good ROCE, good reinvestment. The stock market in India is giving you a free lunch. They're giving you these companies cheaper than what their free cash flows would warrant, and that's why obviously sensible investors in India can make a lot of money, right? And one last bit of good news. I know we faced a lot of flack over the last 20 years. The whole world has given us lectures saying, "Boss, China ko dekho, tum log to reh gaye. Look at China. Look at all the good stuff happening in China." Right? We are very data-driven people, as you know. So we don't sort of listen to the rhetoric. We look at the data. So let's define a consistent compounder in any country: China, India, Brazil, kahin pe bhi. A consistent compounder is a company which is able to do 10% ROCE and 10% revenue growth for 10 years. The reason we're doing this, taking this definition, is in China, you don't have 15% ROCE. In India, we use 15% ROCE for CCP, but in China, you don't get 15% ROCE. So we're taking 10% ROC and 10% revenue growth for 10 consecutive years. 10, 10, 10 is the definition of a consistent compounder, right? If you apply the screen to all the emerging markets in the world, you realize only two emerging markets matter, right? The rest of the world simply is not in the picture, which is China and India, right? Baki koi relevant really hai nahi, right? And if you then say, I have defined a CC, consistent compounder, paisa kitna banta hai, right? The data is startling. Indian consistent compounders generate 2.5 times higher returns than Chinese consistent compounders, right? This is before all the drama that Xi Jinping has done. Even before this drama, Chinese consistent compounders simply were not in the same ballpark as the sorts of companies we invest in, right? Now, why is this? Why can't Chinese consistent compounders hack it compared to our companies? Now, we don't have the full answer, right? We haven't been to China, and we don't know why Chinese consistent compounders are nowhere in the same league as our companies, but we suspect this chart might have something to do with it. And what the chart shows, is this will be familiar to Marcellus clients, is rapid growth in profit share. This is the polarization in profits we talk about. The large are getting larger in India. As large companies consolidate their markets, they gain more profit share. They obviously compound handsomely for you and me. That ain't happening in China. For reasons we don't fully understand, Communist Party kuch kar raha hai, kuch aur ho raha hai. In China, the large companies are diminishing in relevance. Their share of the country's PAT is going down, and naturally, therefore, their compounding is below par, right? The reason we're highlighting this too is our reckoning is on the back of this chart, and we've obviously taken this around the world even as we speak. A couple of our colleagues in sales are meeting American endowments and family offices and showing them this. Foreign investors have 6 times more money invested in China than they do in India, and these are rational people. Even if they were somehow able to look through the harsh rhetoric emerging from China, they will heed the data, and this sort of compounding makes it almost inevitable that the money will come towards India. So I'll stop there, and we'll open up for questions. We'll open the Q&A box. If it's company specific, we'll point it towards Rakshit. So Rakshit, I'll start with. Before we get stock specific, let me take some questions about overall sort of thematic level. Let me take some questions at the thematic level, and then we'll come to come to a stock specific. So actually, just taking up first sort of question, it's a thematic question. So let's start with this. So Amit Sharma is asking that, he says banks are supposed to work in a rising rate scenario. He's listened to Tej's webinars. He's listened to Tej's webinars as to why high quality lenders should do well in a rising rates environment. He's worried about HDFC Bank, Bajaj Finance, and Kotak, right? And he wants to know, are these high performing organizations? Will they do well in the rising rate environment? Is there any comfort that we can give to Amit Sharma about high quality lenders in a rising rates environment?
Sure. So first and foremost, I think it's worth appreciating that competitive intensity in the lending space after a crisis gets more and more muted. As a result, what you see high quality lenders do is they see an increase in the interest rate on the asset side of their balance sheet, and they do not increase the liability side deposit rates commensurately enough, right? So net interest margins to begin with expands as a result in the rising interest rate environment for high quality lenders. Just to let's put it in simple words, people who are investing in fixed deposits with say an HDFC Bank would not have seen the fixed deposit interest rate go up at the same rate as the home loan of HDFC Bank would have gone up after a monetary policy committee rate hike announced. So that's the net interest margin expansion that high quality lenders undergo. Secondly, you also see a reduction in competitive intensity from companies who reduction in the quality of borrowers that a weaker quality lender would have, right? So a weak quality lender will have borrowers that cannot absorb rise in interest rate on the loan, right? And hence the defaults tend to increase for a weak quality lender at a far greater level compared to defaults on the strong quality lender, where the borrowers would have been stronger businesses, better balance sheet individuals or businesses, and hence capable of taking the adverse impact of rising interest rate on their loans that they have taken, right? So from those two aspects, both on the side of quality of assets as well as net interest margins, especially in the aftermath of a crisis and during a rising interest rate environment, high quality lenders massively benefit. Now, in the same question, I think the questioner has also asked, what do we think about Kotak Mahindra Bank? We've talked enough about Bajaj Finance and HDFC Bank. So Kotak Mahindra Bank's competitive strengths are no different. The only difference between a Kotak Mahindra Bank and a Bajaj Finance or HDFC Bank is that Kotak Mahindra Bank is overly conservative in the degree of leverage and hence capital adequacy ratios and the amount of capital they raise before they start deploying it to grow their loan book. As a result of that, Kotak's ROEs tend to be a lot more muted. They're 13-14%. In fact, it was quite positive to see that in the most recently reported quarter, they reported an ROE of about 15%, something that an HDFC Bank does pretty much every quarter with a 17, 18, 19% ROE. Bajaj Finance has in the 20s its ROE, right? Kotak's ROE is far more muted, and that's because of higher degree of cash. It is not because of poorer quality of underwriting, and it is not because Kotak doesn't know what to do with the cash. It's just over conservatism. Whenever they see the opportunity of raising capital at cheaper rates, they go for it. And the deployment, the disbursement of loans, it happens with a lag. Other than that, Kotak has always compounded its earnings despite the dilution in per share. The EPS CAGR for Kotak has always been closer to 20%. Which is what effectively is shareholders' return in the longer run, provided they remain a disciplined capital allocator.
Rakshit, is the whole group of questions. I'll try to club them into one. I think I'll use the words that Nirav Shah has given us. Right. So if you can just think through this and give your answer. So, the point of view that's being articulated is if it's also good, no, all this cash flow is coming through. If all this cash flow is coming through, the fundamentals are so good. Why doesn't it result in higher share price performance, right? Whether it's for CCP or Dr. Lal Pathlab specifically, if you could just get into that. Whilst to sort of you might you get your visuals ready, I'll just take some of the other housekeeping questions quickly whilst Rakshit gives you a point of view. And this is important. I think I'm glad that several of you, AS, Nirav Shah, several of you asked this question. Ki agar sab kuch acha hai, fundamentals are good, cash flows are coming through, why doesn't it show up in share price instantaneously? So while Rakshit thinks about that, some of you are asking, why are foreign investors selling? Agar itna sab badhiya hai, why are FIIs selling? So folks, just put yourselves in the shoes of an FII, and I'll give you a mental model, chota sa quick mental model of how an FII works. A typical FII, say, will be an endowment. They'll have, say, $100 million. They need to generate an 8% return on that. Why do they need to generate? That endowment will be a college or a trust, and that 8% on $108 million will be used to fund half the operating expenses of the college. Right? That's how the endowment works. They target an 8% return on that corpus, $100 million mano, and that funds half their OPEX, so that the students' fees for the university funds half the OPEX, and the other half of the OPEX, the operating costs of running the college, come from the portfolio. Now look at the FII's portfolio. 20 to 30% will be US unlisteds, which have been hammered down 40-50%. All of you are aware what's happening in the NASDAQ, what's happening to Tiger Global, and so on. Another 10 to 20% will be China and other emerging markets, which have also been butchered in the last couple of years. The correction in India, by the way, pales in comparison to what's happened in US unlisted tech, in US listed tech, and in China. Then around 30-40% of the US FII's portfolio will be US tech itself, so US listed market investments, which are down roughly 20-25%, right? Now, S&P 500. So out of his overall 100 rupee ka portfolio, out of his $100 portfolio, he needed to generate $8 to fund the OPEX. Forget generating $8, his portfolio is down by 30. Now the college is saying, boss, paisa lao, we need to pay professors' salaries, college ke infrastructure ka kharcha. He's getting the paisa by selling Indian stocks. He's got nothing else really to sell, right? He's quite literally selling HDFC Bank or Kotak Bank to fund the operating expenses of that college. If it doesn't do that, the college will not be able to pay the gardener's salary or the professor's salary, right? There is nothing else left to sell. China fat chuka hai, US unlisted tech fat chuka hai, S&P 500, generally US listed market is in trouble. We are one of the few parts of the world where large, high quality companies are posting the sorts of numbers Rakshit referenced, Bajaj Finance, HDFC Bank, Kotak Bank posting. Ironically, the FII is selling some of that to fund his day-to-day ka kharcha. Very little of the selling is driven by problems around India, because you and I live in the country. It's pretty evident to anybody with economic base in India, a job or a business in India, that this is the healthiest macro economy we've lived in for a long, long time. FII also understands that. And if he didn't, the work that Nandita and I did with The Economist and the superb Economist article conveys to the FII in vivid terms that you have invested in a superb country. So the FII selling very quickly will become buying, and it will become buying on a scale that we haven't seen before, because as I said, the FII has got 6 times more invested in China than they've got invested in India. Even if one fifth of that money comes to India, you will get a tsunami of FII money coming, which is similar to what we saw actually from the latter stages of 2020 through to the latter stages of 2021. Rakshit, over to you on this question about, if all this business dominance is there, तो share price क्यों नहीं चलता?
Sure, Saurabh. So let me project this, and I'll give you 3 or 4 different ways to contextualize it. So this is how share prices behave after they get disconnected from fundamentals for a while, right? And the first column here. So let me just annotate. So the first column here, this part, right? It shows you it shows you a muted share price performance for 12, 15, 18 months for different stocks. Many a times it's overlapping time periods as well. So the Pidilite June 11 to July 12 overlaps with July 10 to December 11 here. Likewise for a few other companies here, right? So muted performance, reasons, macro, competitive threats, maybe some other concerns, so on and so forth, right? Everywhere you see the reasons are largely inflation, GDP growth slowdown, availability of raw material, some new competitors springing up and doing something, or an economic change like a GST or something like that, right? Those are the reasons because of which share prices give a muted performance, right? Then look at what they do after the holiday period is over. And this is similar to what Saurabh was just mentioning. When the FII buying starts, it will obviously more than cover up for the pressure or the disconnect from fundamentals that we saw previously, right? So if somebody believes that, look, companies like Asian Paints, Pidilite, they are so large, if they fall significantly behind fundamentals, then can you really expect them to sort of post a 40, 50, 60% CAGR in share prices over the next year or two to catch up with fundamentals? Actually, that is exactly what has happened in the past, right? The encircled, the dotted line and encircled percentage growth in share prices that you see after the disconnect with fundamentals is over, right, is quite remarkable. So that's one piece, that they can be disconnected in the short term, but longer term, share prices always do catch up with fundamentals through a greater than normal rate of compounding of their share prices. That's the first part. Now, the second part is something similar to here. Not only do share prices recover, right? This was the GFC. Look at the comparison here with Sensex. Not only do share prices recover, they recover at a far stronger pace than the rest of the market after the euphoria is over, right? 2006-07 was when there was no difference between high quality, poor quality in terms of share price movement. In fact, second half of 2006, quality massively underperformed versus poor quality within the indices, right? But the way that reversed, the way that disconnect reversed was massive, right? The kind of share price movements that you saw through and after the GFC were far greater than the Sensex or Nifty movement, right? And this is similar to what, let's say, Asian Paints has seen every time there is a concern around crude oil price. Every time Asian Paints falls by more than 20% in 3 months, if you buy it, there is a subsequent 12-month time period where the share price on average delivers a 40-50% growth, right? This is again pointing to the same view. Now, what do we do? It's quite interesting to understand what do we do when share prices remain disconnected. We can do two things. One is we say that, look, in the longer term, if HDFC Bank compounds earnings at 20%, the share price will compound at 20%. So let's just stay put. Let's stay fully invested and wait for the recovery, right? We in fact try to benefit from the periods of muted share price performance where the disconnect emerges, right? So 2 years ago we did that Bajaj Finance purchase. Many of you might be aware. 1 month ago we did Dr. Lal PathLabs purchase, right? Now, obviously, we are doing a Dr. Lal PathLabs purchase when people are concerned about Tata 1mg and price wars and various other things. And I think some of you have asked in the questions the fourth quarter numbers, why didn't they grow, etc. That's the reason why the disconnect exists, because people are worried about all of this. If we believe that is not a justified concern, then it makes sense to actually load up on Dr. Lal, shave off from a couple of other stocks which have not fallen much, and benefit from that rebalancing to quantify, right? If you look at this last column in the table at the bottom, to quantify the impact of this sort of a rebalancing exercise within a year or two, once the share price recovers back to fundamental levels and you had rebalanced to load up more on the disconnected share price, the average impact on returns, enhancement of returns, is anywhere between 2 to 4 percentage point on a CAGR basis. And if you get to do this sort of a rebalance once in 2 years in a meaningful way, right? So 2 years ago it was Bajaj. This year it is Dr. Lal. I'm pretty sure in 2024 and 2026 there will be more reasons for market corrections and more reasons for stock price dislocations. And if we benefit from that in the right way, over the longer term, this sort of an activity adds on to 2-3% extra on the portfolio level performance over and above fundamental level performance of the underlying companies, right? So that's one way to understand it. Now, if you really see over the last 3 years, including a muted last 12 months, right? You can see absolute return of high quality portfolio being healthy, relative return of a high quality portfolio also being healthy. The problem is if we all keep mulling over 6 months, 12 months performance, then the disconnect between fundamentals and share prices can be part of the 6 or 12 month period. More often than not, in the longer run, the disconnect doesn't make a big dent on your share price performance. So think about it. Despite the last 12 months of muted share price compounding for our portfolio, when the fundamentals have compounded at a decent pace, the 3-year CAGR is high. Why is it high? Because free cash flows have compounded at roughly 25% and share prices have compounded at roughly 20%. 20% is not a bad outcome, right? So that's, in a way, I mean, 3 or 4 different ways to answer the same question. And at the end of the day, you need to be convinced that free cash flows will keep compounding. If you're right on that conviction, then nothing to worry about 1 month, 1 year or 6 months share price performance.
Thanks, Rakshit. Thank you. So Rakshit, I'll come back to you in a minute with Zubin Ajmera's question on free cash flow, right? So he wants to know free cash flow might be negative for a year because of capex. So kya karna chahiye? Should you sell and run away? So I'll come back to you, but let me go to Nandita. Nandita, so Mr. G. D'Souza, could be Mrs. or Mr. So I'm sorry, I don't know the gender, but G. D'Souza is asking. He's saying that he's heard from Marcellus that a recession gives cheap oil to India, right? Aapke muh mein gui shakkar, as they say. Recession gives cheap oil to India. In a current scenario, recession may give India. In the current scenario, there may be a recession, but oil prices are rising. I think D'Souza's question, Nandita, is if oil prices rise or they've risen, what is the impact on India? What does the data show, Nandita? When oil prices high, does India get destroyed? Nandita, you can hear me? I think there's some problem with the line. So we'll come back to her. I think there's a problem with your line. So we'll come back to you. See if you can just log in and log off and log in, so that we can discuss this point. I think it's a question that lots of people will have. That high oil price. Just log out and log back in, and let's see. Rakshit, over to you on this sawal that Mr. Zubin Ajmera is raising. Nandita, you might want to either mute yourself or log out. So Zubin Ajmera's question mentioned free cash flow might be negative for a year because of capex reinvestment, and that is why in the annual report free cash flow could be negative. If free cash flow remains negative next year, do we exit then? Asks Zubin, or do we still hold? What key parameters should we check to make sure our conviction is strong and we hold on to the stock? Over to you, Rakshit.
Yeah, sure. So, I mean, pretty good question, and I'm sure the questioner has partly maybe gone through our explanation, and hence they're asking more about the next year's free cash flow being negative rather than why was this year's free cash flow negative. So this year's free cash flow negative is for 2 broad reasons. One, in the last quarter of FY22, many companies in our portfolio took a tactical call of benefiting from the adversities faced by the whole industry around raw material availability and high cost of raw material. being made available. So, for instance, when you look at Asian Paints, their inventory days, they went up, particularly in the last quarter, because they could load up on cheaper cost raw material, and they could load up on availability of raw material when competition with global supply chains obviously were becoming very uncertain and unpredictable, right? So it's better to sort of not focus on working capital efficiency for a quarter or two, if there are significant concerns on whether the supply chains globally will be affected by the Russia-Ukraine crisis or any other aspects, and that's what many of these companies have done. So you see in many companies this case, inventory days go up. The second reason why inventory days have gone up is the examples of, let's say, a Titan Page, where these firms have been able to anticipate a very sharp rise in demand in the months of April, May, June, and in order to provide for that higher than normal demand, they've sat on higher than normal levels of inventory, right? So those are the reasons, and since this all it can affect operating cash flows adversely for a particular year, the operating cash flows have been either declining or adversely affected, right? So that's one. The second piece is capex. So if you look at, say, a Pidilite, their capex over the last 4 years has been 4 times higher than the capex over the preceding 4 years, right? If you look at Dr. Lal PathLabs, their capex in the last year was 4 times higher than their annual operating cash flows, right? And this was because of obviously the Suburban acquisition. Now, typically what you see in this portfolio is that these companies, they capitalize on opportunities during a crisis to make either acquisitions or tech investments or business transformation initiatives that add to the muscle, add to the longevity, add to the stability of the business in the longer run. And because that happens in a lumpy way, obviously acquisitions are lumpy. Many capacity expansion decisions are lumpy. Pidilite is opening 12 factories as we speak, and new capex has been done for that, etc. You see the free cash flow becoming negative. Now, interestingly, if I go back and look through the last 15 years, when this portfolio had negative free cash flow, it was FY17, FY13, FY8, and FY9, right? FY8 and 9 were actually 2 consecutive years. So to answer your question in that regard, so every time there has been a challenging external environment, you see free cash flow going negative for these companies, not because their revenue growth moderates, not because their profit growth moderates. It's because of the way they deal with the challenge through working capital and capex, which fuels up further market share gains for the subsequent few years. Now, answering your question in specific, what happens if FY23 free cash flow is negative for a particular company, right? If we understand the reasons for that, and the reasons are very clearly convincing us that there is no decline in the strength of the business. In fact, it has been another year, just like FY8 and FY9 were 2 consecutive years of negative free cash flow for this portfolio. It has been another year where managing the crisis has been the reason, or benefiting from the crisis has been the reason for free cash flow going negative. Then we'll hold on to it. But yes, you're right. If there is no such explanation, and next year if Suburban doesn't fire up, if Adlerite's acquisition doesn't fire up, if Asian Paints' home decor acquisitions, they start burning money unexpectedly, then we'll certainly be concerned and we'll take corrective action.
So yeah, so I'll ask the macro question to Nandita again, and then Rakshit, I'll come back to you for the micro. And the micro question, same subject ka micro question, Rakshit, Archit Maria has posed for you. He's very disappointed with us. He says, how can you say inflation doesn't matter? Why did Dr. Lal report less PAT in the previous quarter? How does Marcellus say crude oil does not matter for Asian Paints? If it does not matter, how will it not show margins how will it not show in margins of Asian Paints at $70 and $120? How can difference not be there? Long-term margins may marginalize, but what about short-term? If the stock goes down 20%. So I'll come back to you, Rakshit. If you could just give the audience perspective on why we don't lose our heads on input cost inflation. Now, I'll pivot the laptop to Nandita for the question from Mr. D'Souza on oil prices. Does India go into recession because of oil prices?
Yeah, so to answer that question, if you just look at the previous decade, which was say around from 2000 to 2008, 9, so 2004, 5, and 6 saw crude prices just pivoting towards the sky, basically. And the economy, the Indian economy in during that same period grew at a very healthy rate of say around 7 to 8% on a real terms basis. So there is no evidence that rising oil prices are sort of indicative that the economy will sort of slow down, because we are a developing country. We need there are needs that we need to fulfill. So it's not that easy. Also, the data shows that it does not really happen that way.
This is sort of substantial this point, right? So many of you, I'm sure, were investing in India in 2004, 5, 6, 7. Oil prices were touching $110 a barrel. I remember by the end of that period, 120, I think, by the end of that period. That was in us zamane ka money. If you bring that to current prices, oil prices basically in the 4, 5, 6, 7 boom were touching $200 per barrel, right? So we are at $108 today, folks. Oil prices in the 4, 5, 6, 7 boom were touching $200 a barrel. And I'm sure those of you lived through the boom, so felt the boom. And therefore, if you adjust for inflation, today's oil prices are not particularly high. The second reason, as Nandita has pointed out, you can do the GDP correlations quite easily. There is no discernible correlation between economic growth and oil prices. The reason for that is our economy actually isn't particularly oil intensive. 50% of our GDP is services, right? Banking and financial services, IT services, trade, transport, hotels. This is pretty much half of India's GDP. We're an unusual developing country. We're an unusual developing country where half the economy is services. Services is much less oil intensive. Manufacturing is only a quarter of our GDP. It's a challenge for the country, but it is what it is. The most oil intensive part of the economy tends to be manufacturing. Last we knew, TCS's share price isn't dependent on the oil price. Last we knew, TCS is not a big user of crude oil. Neither is Infosys, nor for that matter is Bajaj Finance or HDFC Bank. So Rakshit, now coming back to you, Archit Maria, and input cost inflation and our portfolio.
Sure. So, all right. So here's the data, Archit, you might get comfort from. So this is what Dr. Lal has done in the last quarter, right, against the other listed competitors in their non-COVID revenues. Right? It's a massive jaw opening that has happened, and is repeatedly happening now quarter after quarter. Till a couple of years ago, this gap between Dr. Lal and Metropolis on like-for-like basis was not there. That's data point number one, vis-a-vis competition, right? Data point number two, when you look at revenue growth for Dr. Lal, right, and let me annotate, sorry. So if you look at revenue growth for Dr. Lal here, right, you see the healthy numbers for the last 1 year growth, 2 year growth, 3 year growth. When you look at earnings, last 1 year, 2 years, 3 years, right? Now, the challenge is that in the last quarter, you didn't see profits grow at 20%, right? And the reason for that is very simple to understand. In the last quarter, we faced a very interesting dynamic on YOY profit growth, where the base, remember the profit number that you are looking at, includes COVID. I'm sure that's why you're saying it hasn't grown at a healthy rate. The base had COVID second wave kicking off in March, right, across the country, March of 2021, right, and COVID testing even prior to March 2021 was quite a healthy one. Whereas in this quarter, first of all, you had the third wave, right, which led to not too many people undergoing severe COVID-related challenges, because the wave was not very severe on the severity of infection, right? Severity of the illness was not there, although the number of cases were too high. That led to COVID testing not happening as much, right? And at the same time, non-COVID testing was also not happening as much because during a COVID wave, you won't step out of your house to get yourself tested. So you got hit on a year-on-year basis. You got hit twice over. First of all, neither was COVID testing happening because many people were doing RATs rather than RT-PCRs, right? And RATs you could have done at home. Nor was non-COVID testing happening because during the entire month of January, you saw the country shutting down, work from home, sit at home, try to avoid the wave, etc., and rather than go for your normal health checkup during the month of January. So those postponements of demand were the reasons why on a year-on-year basis you saw the quarter being muted. So that's on Dr. Lal PathLabs. If it was a quarter which had anything by means of sustainability of low PAT growth or revenue growth drivers, we would have certainly been concerned. And by the way, on that, I'll just come to in a minute whether Tata 1mg or the price war or something else is behind the PAT decline. PAT muted for the fourth quarter. Now, this is Asian Paints EBITDA margins over the last 2 years. Over the last 2 years, not only has crude gone from, I think, $70 to $120 was your question. It has actually gone from $40 to $120, right? So crude has not doubled, it has trebled in the last 2 years, right? EBITDA margin of Asian Paints was around 20-21% 2 years ago, right? These numbers are at $40 to barrel crude, the first 4 quarters that you see. And EBITDA margin of Asian Paints dropped down to 13% in the September quarter, right? And this is exactly, you can see the gross margin drop as well, right? This is where your argument was proven right, that EBITDA margins cannot stay unaffected for Asian Paints, right? But that was a 1 quarter phenomenon, 2 quarter phenomenon. Now EBITDA margins are back to 18 plus. And in this quarter, the guidance that the management has given, to the extent that you might want to believe in it, is that it will be back to 20 to 21%. And that's where, in the long run, they have always maintained their margins. Now, EBITDA margins are, broadly speaking, unchanged over the last 2 years, despite crude having trebled, right? It's not because price hikes taken by Asian Paints have been 200%. That's not it, right? Prices, in fact, have been taken up by only 24-25% for Asian Paints, right? First of all, these were delayed price hikes. That's why you did see EBITDA drop. Secondly, they are not adequate price hikes to cover up for the mathematics of trebled input cost inflation or crude oil prices or TiO2 going up by 70% year on year, etc. Pretty much in line with year-on-year increase in crude oil, right? Why have these price hikes not been commensurate to RM inflation? The reason is operating efficiencies have provided for a lot of margin resilience. That's why actually you see the recovery in EBITDA margin is far stronger than the recovery in gross margin in the last couple of quarters, right? Gross margins will also come back to the 42-43% level, we believe, in the next 1 or 2 quarters, but EBITDA margin is coming back sooner, right? The operating efficiencies are playing their game here. Now, the competition for Asian Paints doesn't have this degree of operating efficiency, right? Which is where this margin resilience is coming with market share gain, right? Last quarter, Nerolac reported a 20% decline in decorative paint volumes, whereas Asian Paints reported a 8% growth, 20% decline in Nerolac, 8% growth Asian. Profit after tax for Nerolac was 70% decline, 70. Asian Paints' profit after tax growth was 14%, right? So that's where you see the argument that you are putting up working exactly the way you are putting it up on a Nerolac. Margins under pressure, volumes under pressure, not able to pass on the price hike to the customer not willing to take the price increases, and hence the entire fundamental coming down, but not for Asian Paints, right? Paint industries is no different. Yarn prices have more than doubled in the last 14 months. You can see the EBITDA margin at the bottom, right? So there's something worth appreciating about pricing power here. I know it's a term that many people disagree with, that it can be so strong for a company that doubling of input costs can actually not affect the EBITDA margin beyond 1 or 2 quarters, but it does happen in the long run. It does happen. Now, coming to the aspect of competitive dynamics on, let's say, Dr. Lal PathLabs. So this is something worth understanding here. The article on the left is what caused concerns, and maybe Archit, you're also referring to competitive intensity leading to margins coming under pressure. But that's actually not the case, because when you look at what Dr. Lal does in Mumbai, right? You can see, if you can see, read this carefully. These are prices for sugar at 10 rupees, cholesterol 10 rupees, hemoglobin 10 rupees, right? This is not 100 rupee. Dr. Lal is offering 1/10 the price of Tata 1mg. Here, Suburban, in the month of May, it offered a complete cashback, right? So this is not a discount, this is free, right? This is normal in diagnostics. In diagnostics, if you enter a new geography, if you offer a new product, right? So wellness is a new product for India in general, and in Delhi, Dr. Lal offers the price point that private equity venture capital funded businesses don't offer lower at a lower level, right? So to that extent, there is nothing unusual about the sort of prices being offered by a new entrant like Tata MG in a new geography like say Bangalore, Delhi, Bombay, etc. More importantly, it's also worth understanding this competitive intensity bit through let's say the aggregator data of say 1mg.com. 1mg is the parent of Tata 1mg, and 1mg can also tell you how much price, what test is available for in what geography, right? So for instance, in Okhla, Delhi, if you search for this I did on Sunday morning, so prices might be 1 or 2 rupees up or down now, I don't know. But on Sunday morning in Okhla, Delhi, Tata 1mg was offering complete blood count for 319. Dr. Lal was doing it for 350, right? On the same day, urine routine microscopy, Dr. Lal was offering a 30% discount versus Tata 1mg, and 1mg was giving this data to the customer, right? That I'm costlier than the incumbent, right? And here again, for some other, I'm not a medico, so this glycosylate, whatever it is, right? So you can see that there is no reason to believe that Dr. Lal's profitability or revenue growth or anything so far is getting adversely affected. But more importantly, if you really understand, as Saurabh explained in a previous slide, what Dr. Lal has done with system, process, technology investment over the last couple of years, you might actually end up getting more convinced about the fact that although the industry will certainly evolve, Dr. Lal so far doesn't appear to be sleeping over a potential evolution here, and hence our conviction, hence we bought in fact more of it more recently.
Surakshit, I'll give you a question to think about, and then whilst you're thinking about that, I'll deal with a bunch of housekeeping questions that have come up. So several people, I guess we got people on this call who are sort of very proactive. वो सुबह अखबार पढ़ते हैं, WhatsApp पढ़ते हैं. So several people who are on this Zoom call, they're convinced global recession आने वाला है, rates are going up, war चल रहा है, and therefore they're very worried कि क्या होगा investing company का. What are you doing about all this global recession outlook? So just to sort of articulate one of the several questions that have come from lots of key people. Chetan Rajan Saji is asking, how does Marcellus foresee and insulate global effects like recession, bond rates, handling of RBI on interest rates, global economic instability by the developed countries on investing companies? So क्या करते रक्षित इस बारे में आप थोड़ा सोचिए, and whilst you're thinking about it, I'll deal with some housekeeping questions. Some of you are asking, should you borrow money to invest in the stock market? No, never, ever. कभी मत कीजिए. Never borrow money to invest in the stock market. It's suicidal. If anybody tells you it's a good idea, please report them to us. We'll see if some corrective action can be taken against such people. This is not a bad idea. This is not a good idea. Then a bunch of people are saying, InfoEdge के AIF में क्यों नहीं पैसा डालते? If we so like Sanjeev Bikhchandani and his investment team, why on earth do we buy the stock? Why don't we buy the AIF? Two reasons. I think Piyush Chawla ji is asking the question. Piyush ji, two reasons. Firstly, Sanjeev Bikhchandani और InfoEdge के AIF में सिर्फ तेमासेक डाल सकता है और InfoEdge का लिस्ट को डाल सकता है. You and I can't put money in the InfoEdge AIF. It is not open to the Janta to go and slam money into the AIF. I wish it were. I'd also be running towards them, but it's not open, right? Secondly, the second reason for investing in InfoEdge in totality is their operating businesses are actually very good. Specifically, Naukri.com is a dominant franchise in the employment classified space. We are users of it. I'm sure many of you online are users of it. And it's a cash machine. And we want, obviously, as Rakshit has explained over the last hour, we love cash machines in Marcellus. We live and breathe cash machines. So the operating business is great. And by investing in the listco, we not only get the operating cash flows from Naukri, we also get the fabulous AIF, which contains probably one of the best venture capitalists in India's skill sets. And ek stock, do layer of compounding. It sounds divine to us. Hence, we never can understand why people sort of sell InfoEdge saying Zomato ka stock price kya hua, policy bazaar kya hua. That's exactly the sort of nonsense which kills people's compounding. As Rakshit has explained through many examples, we don't pay that much heed to market noise. So Rakshit, back to this point, global recession आ सकता है, Federal Reserve कुछ कर सकता है, व्लादिमीर पुतिन कुछ कर सकता है, महाराष्ट्र का वाटर टेबल नीचे जा रहा है, ग्लोबल टेम्परेचर ऊपर जा रहा है, हॉटेस्ट समर इन 120 years, मेरे बच्चे को कॉलेज में दाखिला कराना पड़ेगा, क्या करें ये सबका, पोर्टफोलियो के साथ क्या करें?
Yeah, I mean, let's just understand one thing, that as long as fundamentals keep compounding, share prices will also compound, right? So that's one piece. Secondly, will fundamentals be affected by any of these events? Is the one layer deeper question. Now, all of our portfolio companies are selling products and services in India to mass market and upwards households. Their products and services to American households. So America going into recession doesn't affect the demand for our portfolio companies. When it comes to supply, that's where actually you saw the examples where Asian Paints is saying, I don't know how easy will it be to procure raw material 3 months down the line if something bad happens to China, Russia, Ukraine supply chain. So let me just pile up on raw material, load up on raw material in defense. And that too, in a rising input cost inflation environment, I'm getting raw material at relatively cheaper prices. Let me do it, right? So that's a short-term tactical sort of supply side dynamic offset that these companies are playing for. So that's where the American economy going into recession, Russia-Ukraine war, etc. It becomes an event that doesn't affect fundamentals. What happens to inflation in India, GDP growth in India, and hence the impact on demand for the products of our portfolio companies? So it could be possible that if inflation remains very high for India, and I mean, we are not experts on why crude oil prices will remain high, for how long they will remain high, so on and so forth. Although we do believe that if larger economies globally, they go into a recession, then demand for commodities will fall, the prices of commodities should reflect that, etc., etc. We'll see what happens, I don't know. But there could be a case where 100 basis points, 200 basis points in adverse impact on economic growth happens for some time. I don't know how many months or quarters, but that is possible. If it happens, then we go back to the analogies of demonetization, GST, COVID. All of these events did lead to slowdown in economic growth rate for a while. During that short period as well, our portfolio companies, they managed to accelerate market share gains through various means, which actually becomes the reason why there is resilience in their fundamentals, which is why they consistently compound their fundamentals through the thick and thin of external environment, right? So that's the line of thought that you need to ask, understand, debate, etc., right? Now, what do? One, we sold off companies like Abbott when we saw their response to the external environment or to competition not being as good as what we would like them to see. Or on the other extreme, we load up on Dr. Lal, Bajaj Finance when their share prices fall and our conviction levels on their fundamentals, they don't drop, right? So those are two extremes. Abbott as one example, Dr. Lal, Bajaj Finance has other examples, and in between, I mean, if there is no dislocation of share prices to benefit from, if there is no reduction in fundamental strength, then we just sit tight and we wait for the share prices to catch up with fundamentals. That's what we recommend you should also do. There is no reason to believe that if America goes into recession, then Asian Paints will stop painting walls in your and my households.
And Rakshit, one last question I'll put to you, and you might want to pull some material together to help answer this. So, Rupam Dev is asking a question lots of people ask us, and I think it's a valid question given how big a holding HDFC Bank is for us. So, the question is that, look, he says, I understand that HDFC, when you merge HDFC and HDFC Bank, he says he understands that HDFC will benefit from the low cost CASA. But he's saying, how will this benefit compare with the increased CRR and SLR for the combined entity? So I think Tejas, you might want to whip out the note Tej wrote for Kings of Capital on this and use that to answer the question. Whilst you think about that, let me just deal with some housekeeping questions. Narendra Babu is asking, can you get a webinar recording or PowerPoint? Yes, absolutely. So the webinar recording will be on our website. You can get it on YouTube as well. For the PowerPoint, you have to write to our client support team, and they'll make a call on that. But the recording certainly will be both on our website and on YouTube. Mr. G. D'Souza is again asking for books that we are reading today. So we loved reading Sebastian Malaby's biography of Alan Greenspan, The Man Who Knew. Super read, especially for those who get very worked up about interest rates. काफी लोग गर्म हो जाते हैं, right? Interest rates के बारे में. If you read The Man Who Knew, Greenspan's biography, you'll realize how little thought goes into it on the part of the central bankers, and you'll also realize how weak their read of their economies, how often they get it wrong. And the reason I'm saying these realizations are very useful to understand, and Malaby's done a beautiful job in the book, is these firm prognostications we get from these characters who yap away on in media about US mein recession aayega. These are very shallow prognostications. Even for the Federal Reserve, it's actually not obvious where the US economy is going and whether rates need to go up and how much they need to go up. So when anybody hears pundits confidently saying US recession mein jayega, India ka ye hoga, LTTS ke order book mein wo hoga, immediately know that sort of point of view has very little substance behind it. So The Man Who Knew, Sebastian Malaby's biography on Alan Greenspan, superb read. We've also, many people in Marcellus love reading Fortune's Formula by William Poundstone. It's a book on how you should think about risk, position sizing, generally bets in life. If you're running a business like we are, you might want to figure out how to capital allocate in your business. Beautiful book, Fortune's Formula by William Poundstone. And for anybody else who's trying to figure out how to think long term, right? Rakshit gave you a masterclass in how to think long term. Read Roger Lowenstein's biography of Warren Buffett. It's called Buffett, The Making of an American Capitalist. I began the presentation by telling you what we are replicating is the American century, right? The industrialization of America. We don't know that much about investors in America before the Second World War, but we obviously know about Buffett's life in great detail. And his book is Roger Lowenstein's book, Buffett, The Making of an American Capitalist, is a beautiful demonstration of how much money a patient, long-term oriented, sensible investor can make, provided he or she blocks out the nonsense noise about, Tata 1mg ka ye ho raha hai aur HDFC Bank ka CRR SLR ho raha hai aur Federal Reserve ho raha hai. For those who have the mental capacity to block out noise, the riches are enormous. One reason we do these webinars, right, and one reason we write books is so that hardworking folks like you don't do suboptimal things in times like this. When stock prices are going up, everybody is a share, right? You don't need to read books, you don't need to watch Marcellus webinars. When stock price is going up, everybody is Warren Buffett, right? Everybody is a long-term investor. नानी याद तब आती है जब 40% गिरता है. That's when the training, the intellectual training, the research, the ability to understand the company inside out, that's when all of this actually becomes relevant. And that's why we do these webinars, so that those of you who have worked so hard for your money don't do suboptimal things when stocks are going down. Instead, you do what Rakshit just described. You buy hundreds of crores of Dr. Lal Path Labs, right? So the reading, the webinars, the newsletters, they're actually being the most critical at this juncture, not when stock prices zooming up. Then to even the auto rickshaw driver who will take me home, even he's Warren Buffett then. So Rakshit, back to you for the last question of the day. There's several wonderful questions. I wish we could take them all, but let's end today with HDFC Bank.
Sure. So this is the newsletter our colleague Tej had written, right, where he clearly articulated that look, because of sort of the drop in leverage, etc., the ROEs are likely to moderate as the book becomes bank-owned book. HDFC Limited's book becomes bank-owned book. But then over a period of time, as you do the math, how efficiencies will play out, and then mortgages inherently they require low capital, right? Because of the lower risk rates, you will see the ROEs come back to 17-18%, right? So when you look in isolation, the ROE will certainly go through a decline in the short term. But when you look at the combination of all of these benefits and hence its impact on ROE over the slightly longer time, you don't have to wait for 10 years for that. Much sooner, you will see the ROEs recover back to healthy levels.
So thank you for that. Thanks, Rakshit. Thank you, Nandita, for the hard work which has gone into building this terrific presentation. Thank you. Thanks, Pooja, for hosting us, and thank you everybody for dialing in. Keep the faith in the country and in the stocks, and you'll see it will work out for you. Good night.
Thank you.
Thank you all.